Right, jet setters, it's been a while, but I thought I'd do just a few videos because it's just a bit over 12 months since I started doing these. And I did, it was quite diligent for the first 5 or 6 months. And then the last few months, just haven't been bothered doing them really. But I thought I'd do them mainly for my own reflection and benefit, but I hope if anyone watches these that it's useful. So the short version is I started doing these videos in September last year. And since then, with my trading, I've made about, it's about 500 biscuits is the short way of putting it. Let me just get this up here. That's basically my breakdown over the last 12 to 15 months. So it's been a pretty good year. And I guess I want to do this, again, partly for my own records, really, because I find doing these videos quite helpful for myself. Just to kind of reflect on what worked and why. So that one, that trade, that oil and gas one, that was basically, I saw the oil markets take off. I saw an opportunity that I'd missed. I went to look a little bit laterally to try and find out something that had lagged so that I could take advantage of it. And I found an oil and gas company, Woodside Petroleum in Australia. I sold a bucket load of puts, slightly in the money, shortish expiry, picked up the premium, got exercised. The stock then took off as I expected, picked up a couple of juicy dividends, and so that was literally one trade. So one of my reflections is it's not just an 80-20 rule, it's more a 90-10 rule. You do hear about people saying, most traders make most of their money from very little trades. That's one of them. And so I'm pretty happy with that one because it was a bit of a macro trade in oil taking off, but it was also a bit lateral because I was pissed that I'd missed the big rally in oil. I remember sitting in the middle of the night when oil went negative, and I had too much other stuff on and I didn't take advantage of it. I was always kicking myself at that, but I got there in the end because I just looked a bit sideways. The next big bucket of trades at work, there's a few more of these, were I saw my broker put me on it that US 2 years were rolling over, and I just went short those bonds. I went short the US, the 2s, the 10s, I went short the bunds, I went short the Aussie bonds, and part of that was just, look, these yields are ridiculously low. It's very asymmetric. There's a big macro trade because I believe that inflation was out of the bottle and people hadn't really twigged onto it. And part of it was a hedge for loans that I've got against other trading positions. So there's a few things in there. So a few more trades. It wasn't just one, but some pretty simple trades that really led to that. There were some other ones like some spreads in there, relative value, like Aussie versus US yields. Like one of them at one stage in the shorter end, the Aussie yields, 3-month yields, were higher than the US ones, and I thought that's backwards because Australia isn't going to be able to hike anywhere near as much as the US, just because of our housing market, and also our inflation wasn't as out of control at the time. So there's a few other relative values in there. The options, most of that was literally from one strategy, which was selling puts and rolling them on Telstra. Telstra's an Australian stock which really isn't very volatile, and I saw that it had rallied up towards $4, and I thought it's just going to sit here like for the duration, and it did. So I was just selling puts and thought, well, if it goes down, it's got a yield that will cover my cost of carry. I'll turn around and sell calls, and so I made 83 biscuits just out of that one strategy there. That won't last forever. That'll go. The commodities, that's been out of a few plays: short gold, short copper, short coffee. And the coffee one in particular I'm happy about because I'd seen a lot of commodities rolling over, and I was similar to the oil and gas trade there, I was thinking, well, there's got to be some that haven't quite rolled over yet. And I looked at coffee, and coffee hadn't rolled over yet. So the bulk of that is actually from just a single coffee trade. The equity futures, that's trading the S&P and our Aussie market. And again, that's actually where the most trades have been. But really, in the scheme of things, that aside, the number of the P&L for the per trade is all out of whack. This is high effort, low payoff, low effort, high payoff, low effort, high payoff, low effort, high payoff, low effort, high payoff, high effort, low payoff. High effort, low payoff spells hell, Brian. So, that for me was a good example of, for me, where I make my money, it's out of the good longer term trades that have got like a compelling macroeconomic or fundamental value play, as opposed to jumping around. I've got some of the moves here, but I've been on the wrong side of a lot of them just because of the volatility. And in a way, the bonds, they behave far more sensibly to macroeconomic news. Equities are just all over the shop. And FX, that one, I've had a few trades there, but really that's a bit of a sleeper because I've loaded up on the Aussie dollar when it was down at 63 cents. And I'm waiting for it to come back to around about 75, and I'll make a good return on that. So that is the breakdown of the year. And as far as my reflections, really there's kind of three rules to trading as far as I'm concerned, right? One is be patient but decisive, right? Patience is the key for me. The other one is it's the second trade that counts the most. Be patient. Wait until you buy or sell. The second one is where you sell or you buy, in terms of cutting your losses, letting your profits run. That's really where the secret to making money. For me, cutting out my losses has been a big factor, particularly in that equity basket. And then the third one is keeping a trading diary. And for me, the videos were very helpful when I started doing these videos, and for me listening back to them, that was probably the biggest influence on clarifying my thinking and the positions that I put on. So they're really the three rules. The reflections for me though are this, and so those three rules, they're general. For me, the specific things are, I'm essentially a macroeconomic trader. And so for me, the best trades, the ones where I make money with a low effort, high payoff, they are ones that are compelling, deep value and asymmetric, to the extent that I haven't needed to put a stop in place because the value is so compelling. So that's like long the Aussie at 63 cents. It's just a no-brainer. That trade, we're waiting for an oil and gas miner that's highly correlated to the oil price, waiting for it to catch up to where the oil price was. Just absolutely compelling. The 2-year yields, when they were so low, shorting the bonds was just absolutely compelling. Commodities rolling off, coffee waiting in the setup was just totally compelling. Selling vol against Telstra when the markets were volatile but the underlying stock was just not volatile, no brainer, right? So the trades that I've had, they are just compelling. You see them and you go, mate, that is the bomb. But to get there, it takes patience. So for me, I'm not a patient individual. The trades that haven't worked have just been because I've been impatient. For the equities, the big indicators that I've found that work for me and my style are our RSIs, and I'm talking like 4 hours minimum, like that for a time frame, going out to daily, weekly and monthly. So that's the time frames that I trade on. The best trades that I've got are ones that are weekly and monthly. Jumping around equities on 4 hourly is okay, but it's still pretty volatile in terms of certainty when you look at the effort payoff that I've got there. Another one is the price action, looking for this death pattern and major reversal. So I'll go through it in some charts, but it's basically when the price zooms up, doesn't look back, then there's a pass the parcel at the top, then it breaks the neckline and it just plummets down. And it happens like both ways. Some people call it filling the gap. I think it's actually a bit more complicated than just filling the gap, because of how it creates the gap and then how it pauses before reversing. But I've seen that in coffee, copper, the US 2 years, gold, and especially Bitcoin. That has been a big thing that I've really learned over the last 12, 15 months, is being more aware of that pattern. For me, that's probably the biggest indicator out there, that and getting confirmation from the RSIs on a longer time frame, like monthly or weekly. Another is macroeconomics. For me, term trade is just a disaster. It's like hit and miss, break even at best. How people do that, just intraday trading, it's, to me, I just think that's you're just rolling the dice, and it's high effort, low payoff. The other one is the lateral thinking of sorts. So that was the one I talked about when I went long Woodside, because I'd missed the move on oil and it caught up. Another one was when I was looking at the curves, the Australian bank bill futures versus the US 10 years. And at one stage I made good money on that, just because of the spreads between that. So I was really playing the spread between the Aussie and US 10 years, as well as at the same time the curve between the Aussie bank bills and the Aussie 10 years. And because of where the US was trading to the Aussie 10 years, I was able to pick up extra points there. And again, that commodities and coffee trade that I've mentioned. Another one, which has been, I guess, my curse in a way, is never sell your best assets. So this ties back to these two things, right? Where they're like the bunds. I was short the bunds, and I made a good lot of money there. Then when they pull back, I cashed it in, and I missed the next move, which I was really frustrated about. That cost me a good number of biscuits. and it was very frustrating, because the reason why I got onto the trade in the first place, it was still valid even though there'd been a pullback, and there was no need for me to stop out. I wasn't patient, and I let go of the big macro factor on those bunds and the compelling of that trade. And really that was me losing sight of why I did the right thing in the first place. I was really pissed about that one. Another one is using stops for the shorter term trades. Stops for me have been obviously essential, but for the trades where I made the most money, I haven't even had to come anywhere near even thinking about a stop, because they're so asymmetric and the value has been so compelling. So it's almost like if I'm leaving a lot of call levels for stops, I have the wrong positions on. It's as simple as that. I haven't had calls for like in the middle of the night for a while, and it's because I just had the right positions on. When I was getting a lot of calls, it's because I was over trading. I had too much of a short-term horizon. They were trades that were not asymmetric, compelling, and deep value, and I hadn't been patient in getting them in. Again, feeding that, for me, it's at least an 85-15 rule, in terms of 85% of my cash comes from 15% of my trades. I've looked at it time and time again, and it really comes back to around about that ratio. So for me, it's about really being patient, right? So I'm not over trading, so I'm not even worried about stops, so that I'm getting the setups right, the price action right, the macro mix right, getting where the value is and being patient. And then the last thing is keeping a trading diary and learning from it, which is why I'm doing this last video. For me, as soon as I started doing the videos, that significantly helped my trading pretty quickly. And for me, I listen to my videos more than anyone else. I like the sound of my own voice, but it means when I listen back to myself, it is that reality check of like, do I sound like I'm talking shit, or does this make sense? Verbalizing these thoughts, for me, it gets it out of my head, it gets it into, I guess, a bit of a space where I'm a better judge of what I'm thinking and saying. So that's the reflections really for me. It comes back to the biggest ones are these two. patience is key. Without patience, whoever, will piss away money on trades that are not compelling with deep value and asymmetric, right? These are the ones that have made me, with 15% of the trades, and maybe 85% of the cash. So they're my reflections, right? Going back to just a bit of walk through history. So when I started doing these videos, I did them for a few reasons. One was I was just sick to death of all the bullshitters and shysters that were out there, who were they were kids, they were babies, they were juveniles, influencers or whatever. People doing these shitty videos trying to rope you into their private courses, their chat rooms, selling all kinds of stuff. These people, they'd never had any financial qualifications, never had any serious work experience in a reputable house. They were just bullshit. Never really fessed up with what positions they had on. John Howell was one, probably one of the worst I've seen. Greg Secker and his offsiders, absolutely goddamn full of shit. These guys, they are shysters. And thank God ASIC has started to, in Australia, has come around to shut them down. And I read this morning or yesterday, some Lamborghini wanker has been shut down and getting chased by ASIC because although he was saying these are education, he was charging people for all this stuff. So a big part of my motivation was a bit iconoclastic, like trying to set people straight and saying, do not listen to those bullshitters, don't get sucked in. Another one really was for my own benefit. But it started really here, like in September last year, where I looked at what was going on in the market and I said, there's a few things that are saying to me, this is the top, and I was calling it the top. One was on a monthly level, there was a engulfing bearish candles. That's on a monthly, you can see it. And I look back and think, these monthly bearish candles don't happen very often. Like there, here, you know, they are they are a very big precursor, like through here and here and here. They're a very big precursor here to major corrections. So that was one. Another one was this narrowing rising wedge, which to me looked like it was going to fall off a cliff. Another one was, I had looked, funnily enough, I'd found a weird thing on some of these dates. See how that's the 17th of May? There's another one here on, and if I go down to dailies, you'll see it here. It's actually in June. It was exactly the same date adjusted for calendars. There was another one here. So again, that's the 19th of July. And there was another one here, right? And I looked at these ones and said, what is going on here? And I'd never seen it before. It wasn't related to options expiry. But on each of these days, the 17th, 18th and 19th, and just for holidays, there was big selling on 2 days and then a recovery the next. And to me, I looked at what was going on here, and you can see it here when it went down again on that same date. Go down to like a daily time frame, you'll see it. But to me, it was 1, 2, 3, and I thought, and I made some money here. I thought, right, it's going to do it again, and of course it didn't again. Hasn't done it since. But to me, it was a bit of a look. There is some big fund out there that is determined that this is the top, and that's it. And another factor in it was when I looked at the Bollinger Bands. On the you see on the weeklies, it was right on the top there. I can't remember if it was on the monthlies as well. I'll find it in a second. No, but on the weeklies, and I think certainly it would have been on the dailies as well. Let's see what it says on the dailies. But I just saw on the Bollingers, it was like, yeah, it must have been on the weeklies from memory. But I just looked on the Bollinger Bands and said, look, it's right at the top. This kind of wedge, it's due for a pullback. And I think another one was when I looked at some RSIs, it had been overbought, and you can see it there, like that's on a weekly RSI, it was overbought. I can't remember if it was overbought on a monthly. Look in a second, hey? It might have been. Yeah, overbought on a monthly. So, and it just started to roll over. So there was a few factors there that I thought, right, that's it. That's the top. I was almost right. So I made money here and got cleaned out on the way back. But sure enough, I mean, the interesting thing about it was when you look at the top there, it really was a significant level because it came off it, went through it, bounced, came through, hit it from the underside, hit it from the other side again, and then it's all over. So that was really that observation that triggered a big part of what I was looking at in terms of shorting the market. So that was one compelling trade. Another compelling one was when I looked further back from this level to here, that day there, 154 bars, right? And that's from that GFC low right up until where it peaked, which was in January. Let's go to a log scale here to make it a bit easier. When it went from 75 up to 87, you wouldn't believe your luck, but from that, it is 154 bars. And if I just do it, adjust it, so that is like when it started to, when it came off its lows to when it tanked, 154. And then, where is it? I think it's from here. So here to there, I think it's the same, 154 bars. Yeah, so from that level, 153. It would be 154 anyway. So that, and that, to me, that was just astonishing, right? And so when it did finally turn over in January, I thought, look, the Cycles fans would love that. It's totally over, rover. So that was another high compelling trade. But as you can tell, I was totally right on all these things. But to monetize it, that's a different matter. And I think that's a thing, like another reflection is I was absolutely right on my call for this market in terms of the top there, bit of noise here, but 4,500, to me that was the top. This was just a flush out, right? That was the top, and if not, it was certainly a very good level to sell at. But I didn't hang in there because when it goes off, you just don't really know, do you? And then this with the timing in January, I was like, mate, that is right. But again, short it, then it starts coming back and it does clean you out. Short on the way down can clean you out, short can clean you out. So I've made money on the way down in these dips, but it is easier said than done. And that is the big thing for anyone listening to this. When you look at technical analysts, they can talk a great game, but at the end of the day, frankly, they are inevitably full of shit because it is very easy to say it, very hard to do it. Another couple of things that I had in mind on the way down, which I have to say I was very happy about nailing. One was, there was a gap here, which always bugged me. And it had bugged me for a while. And you can see it specifically just in here where all the way through here, right? When it spikes up, it comes back, it revisits that level, right? It kind of revisits, even here, it kind of revisited a little bit. Here, it just shot through, never closed that. And I thought that is the first stop that it's going to, and it went to it. I did have an outlier down here and said, look, there's a bit of a gap you could argue for here as well. It's not as clean, right? It's a bit more noise, but see these two big highs here, one there, and it went through, sort of had a little test here, but not really. The next big pullback it had was way up here, and it never came back to test these. And so that was another target on the downside that I had, which was here, which it's hit. That is a big level. And really after those levels, I mean, the next one is, like kind of down around here. So that's how I'd called the equity markets. Another call that I had on the equity markets, which was related to that, was the Russell 2000, which had done that death pattern that I talked about at the start of the video, where something shoots up, right, doesn't look back, plays past the parcel, and then when it breaks down, boom, all the way down to there, and it totally hit that target. I didn't trade any of this though. The volatility on the way down is a pain in the ass. It messes with your mind. On equities in particular, you've got to be, with those longer term plays, you've got to be very strong in your convictions, and you need small positions because if you're running big positions with tight stop, you just get, like wiped out, even though you're right all the way down. So those equities, they were some high conviction trades. Another high conviction trade which paid off was the US 2 years. Let me just change this around, and you can see quite clearly it had that same death pattern here, right? But just the other way around. My computer's running out of memory. Where it went all one way, didn't look back, past the parcel, and then when it broke through, it was off. This was a trade where I got in and made a good deal of money, but I got out of it because it had reached my target and was round about here. And you can see that it still went a long way past there. It coulda, shoulda, woulda, had my convictions, shoulda held on. Having said that, what I'm seeing now is this. Right? This to me looks like a topping pattern past the parcel. When you look at the 2 years going back further, when it turns very quickly. Boom, 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 boom. To me, this is turning. I think on a few measures you can look at it on a log scale and go, there we go, right? That is, if we do it, let's do it from there, right? Touch, 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 almost touch there. It's on that level you could say, look, it's certainly hit its target. I think probably more meaningful one is, this whole level through here historically has been a big turning point for it. I think there's a few reasons to say that is time to buy those 2 years, and you can see here how heavily overbought it is on that monthly time frame. Like leading up to here, and it's been overbought like for a while. So you say, look, overbought there, what happened here? Turned, overbought here, what happened? Turned soon after, overbought here, what happened? Turned soon after, overbought over here, what happened? Turned soon after. So to me, this is buying 2 year notes. I've started to do it. That is, despite inflation, that is one of my high conviction trades going forward. Another one now I look at, I talked about coffee. And this is another example for me. This is coffee on, that's monthly. So that's weekly, let's go to monthly, right? You can see this is coffee on monthly going back 40 years, right? See, look at that. This is what it does. It spikes and it really pulls back. Look here, it spikes, really pulls back. Spikes, really pull back. Spikes, really pull back. Here, spikes, look at that. So I'm still waiting, I'm still short this and waiting for it to play out more, but you can see it's still, to me, that pattern, that death pattern I call it, which you kind of saw here as well, where it shoots up in, in one direction, never looks back, has a bit of a pass the parcel, and just plummets back down. And so for me, when coffee broke through this level, like around $2, that was time to get onto it to short it. It's having a bit of a pullback here. I'm holding my nerve, waiting for it to go back to there, which is my target. It's tricky because we hit oversold on the weekly, which on some levels is a good thing to buy back, good level to buy back. It would have been good, but then it's tricky. When do you get back in? And you can see it's turning on this level here. That's where it's turning, which is no surprise there. But this is another great example. Shot up past the parcel, broke down, and when it broke down, it breaks down to where it came out there. So that's really what I'm looking at there. One that hasn't done that for me yet is gold. And to me, it's that same thing, right? Where it kind of shot up. This isn't as clean though. It had like a good double top there, came back down. It's having a retest. You can see there's a lot of noise at this level. I think, or I'm hoping, it'll go down to 1300. It's a bit of a tricky one, but we'll see. One that is very much of that death pattern that I didn't make any money out of it, but to me it was a bit of a risk appetite style call that I saw flow through into equity markets was shitcoin. And again, the pattern of death. Look at this, where it shot up past the parcel. As soon as it broke that level, down, right? So that's on one measure. That's where that. So that's, to me, that's a target like around about 12,000. Another reason for that target is if you look from here to where it went, where it broke down. So that's call it 57%. From that level down here, 60%. It's basically the same, and that is a classic thing in it's actually, it's from there, right? It'll probably be spot on. When something is very close, when something does a range, right, then it breaks out of that range, it sells in a new range, and it goes to like 1 for 1. Another thing that to me has got that target in mind is this little extension. Let me just clean this up. Right. Okay. So you can see, like from there to there. Hang on, actually, so no, it's from there, that first leg, to this high there. Look at that. That ratio, that to that is 1 for 1. Okay. So for the Fibbo guys, this 1, 2, 3, 4, and this fifth wave down here is pretty compelling. But that leg will be the same as that leg and would take it to that target. I guess the reason why I'm still watching shitcoin is because it is a risk indicator for things like the Nasdaq, which then flows through to the S&P. So that's some of the big macro calls. I won't go into the Aussie. You can see the Aussie for yourself. Bonds, coffee, gold, copper. You can see is similar to coffee. You can see here we've got the same concept, right? Shot up, past the parcel, broke down. It's coming back up for a retest. Looks like it's hopefully stalling there to come back down to hit that target there. That is a bit of a trickier one because copper's got some, I think, stronger fundamentals than coffee, but we will see. But recessions will lead to lower copper prices generally. So that's looking backwards. The past year with reflection. So it's been a pretty good year, and I guess for me those rules about being patient, trying to find the good macro things, watching out for this pattern, they're all key for me. I'm going to do another one shortly about looking forward, and I will get onto that shortly because it look. Oh no, this is going forward. Yeah, I'll get onto that quickly now. This is something I find fascinating. This is the Dow, the Nasdaq, the Russell, and the S&P, right? And you kind of look at it from, look at that, from April last year through. Oh, look at these. Oh, they're all the same. They're all the same. They'll go up, they'll come down, you get a bit of noise, whatever, right? This percentage scale. And then you start looking back and you go, what's going on here? And you just look back a little bit further and you go, right, well, this blue line, that's the Nasdaq. Well, it's really, really outshot and rolled over, right? This is the S&P in here, right? S&P. The Dow, where's the Dow? Let's put the Dow in and out. Come back. The Dow hasn't really kind of rolled over, and the Russell really hasn't either. So the thing that's really pushed the S&P down is the Nasdaq rolling over. Okay, that's what's really hammered it, which makes sense because this was all a rates story. My thesis, in a way, is that, well, the Nasdaq still might have more to go, although you can see here on a big monthly scale, sort of hit a good point. But when the Dow then rolls over, because the Dow will roll over not because of rates and valuations, but because all the money that switched out of the Nasdaq, stayed in equities, moved to defensives in the Dow. When the recession comes, the Dow's earnings will get hit, which will reflect the valuations. And when the Dow turns, right, which is on much healthier valuations, let's just make it stand out a bit more. Okay, right, that's the Dow. When the Dow really says, fuck it, that's it, I'm done, that's really going to hurt the S&P, okay? Because the S&P, is that the right one? Oh, that's right, that was the S&P. But the Dow, let me get the Dow, yeah. See, the Dow, it's still not far off its highs, right? And so what is going on here? The rates hikes have crushed this because that's the valuations, and so it's made the S&P go down. We'll get rid of the Russell. The Dow has sort of hung in there surprisingly well. Why? Well, switch to safety. What's going to hurt the Dow? Recession. Recession isn't going to hurt these guys because they weren't making profits anyway. Right? Their earnings won't get hit because of recession because half the companies weren't making money anyway. Right? But the Dow, profits will get hit, and so when it goes, that's really going to drag the S&P down. Now, when we start going back further, we see some really interesting stuff saying, well, holy crap, look how far the Nasdaq has really outperformed, and actually it could really have a long way to go because look at this gap. And this looks very, very, very disturbing as far as where it could come down to. Okay, I mean another, what's that? Another 20% on the Nasdaq. That's going to be interesting for the Dow. So you kind of look back and you go, oh, peekaboo. When was the last time this happened? Right? Here we go. We're going to look at this and we go, holy crap, right? Like, look at that, look at that, look at that. That's terrible. Has that ever happened before? We go, you bet it has. This is back.com, right? And of course, what happened? It went right back to the old death pattern where it shot up, bit of parcel, all the way back down. Yeah. So if this is anything to go by, the Nasdaq still could have quite a bit of way to fall. And notwithstanding that, when the recession comes and the Dow starts correcting because of earnings, not just because of valuations, then that is really going to pull the S&P down. So that's one macro thing that I've got my eye on, the Dow turning because of a recession, therefore dragging the S&P down. Another one which is sort of related to that, which is a bit of a high conviction one, is this is the S&P against the 2-year yields. Okay, so we can see a few things here, right? This is back.com, okay, 50% fall, come back to that. This is the GFC, 57% fall. Right? This is COVID, 35% fall, right? it's got 37% fall here, would take us back to like around about 3,000. Heavy correction, but just keep that in mind. The thing that I'm looking for here is this line is the 2 years, and the thing interesting about the 2 years is when it turns, it comes down, it has a bounce, and then it has a second stab. Here again, right? Kind of had a bit of pass the parcel, drops off a cliff, has a bounce, has another stab. Here, drops off a cliff, has a pause, didn't have a bounce, add another stab down, right? 1, 2, 1, 2, right? 1, 2, okay? We could be in if those three things are any guide, and they're all different. The .com was different to the GFC, which is different to the whole COVID thing, and this 2018, last time when the Fed, raised rates and said, oh, choking. They're all different, right? But there are similarities in the curves kind of show how the Fed responds to what's going on, right? And how the market reads it, right? Which is a sudden reversal and generally 2 legs down. Now, the interesting thing about that, of course, is when the market turns at 2 years turns, the equity markets they follow through pretty quickly afterwards, right? So it's all afterwards here. So here peaked there, and then the equity started to turn. So here the 2 years peaked there, and then the equity started to turn, right? So generally what seems to happen is the 2 years tops and turns, and the equities come just crashing down soon after. So to me, a big macro thing this year is basically long bonds, short equities, and I'm watching that. It's a tricky one, right? But I do think when we look at the 2 years a bit more closely, this is the 2 years here, we can certainly see a few of my warning signs all the way up without looking back. A bit of price stability past the parcel, falling off a cliff, and the way I draw the line, it's actually there. I think it's starting to draw the line because a lot of these patterns, they go up, they hit a level, they have a quick pull back, and then they break above it, they bounce, declining price volume, pretty declining price levels, and then when they break through, could be a very sudden walk down from that level, which is over here. That's like that 4.25-ish% at the moment, down to 3.5. That could be a very sudden turn, and the equity markets will come down with it. The flip side of that, of course, is you can see when the 2 years bottoms. The interesting is the market starts rallying just before the 2 year bottoms out. So just as the 2 years sort of leads the market on the way down, the market actually leads the recovery. So here you can see the yields bottom here, but the market stabilised before. The yields bottomed, down here actually, and the market rallied well and truly after that. The yields bottom here, the market had already rallied. So that's and I guess you can see the same thing going back here. The yields bottomed here, but the market had already bottomed before that. So the market will bottom before the yields bottom. So short the bonds a bit longer than being short the equities. So what I'm really doing is being long the bonds here. Equities should follow. Then I'll let the equities hopefully follow through, or basically turn them into like a long before I stop out of the long bonds. So that's a big macro thing, and that probably is like my biggest macro conviction at the moment. I've got another one which is the US 2s and 10s flattening, steepening. So that's just a one I've got sitting there. You can see some of these other ones. Copper I've got on. Bitcoin I'm kind of watching. I've got a few other positions on the Aussie here. Just touch on the Aussie quickly. Also there's gold, so still short gold. Let's have a look at the Aussie if I can, and that'll be the last one. look at that, right? This is the Aussie going back, till day dot. It's sort of like, look, the range is there. Outliers, but that's the range. 63 is a buy, 80 is a sell. So I'm sitting there along from 63, just waiting for it to bounce up, and we'll slightly take it out in turn. Look, that's it for me. That's probably the last video for a long time, so I hope that's useful. When I look back, I'm pretty happy that I've picked it like a nose on a lot of those trades, and it's paid off for me. I'm very happy that some of these stupid dumbass influencers have been copping it up the ass. And I've said before, if anyone tries to sell you a trading course, run a million miles. If anyone's trying to invite you in their private chat room, run a million miles. If someone's, saying you can make a living out of this with only 10 minutes a day, run a million miles. They are lying, right? If someone's trying to tell you there's a system that they've got that's got a 90% success rate, run a million miles. If someone's saying, look, I had cancer and look at me now, run a million miles. Watch out for all these warning signs. There are so many shysters out there. It fucking drives me up the wall. If you're thinking of doing what I'm doing, right, do not do it. As simple as that. Do not do it. It is very risky. 90% of people lose money trading financial markets with any degree of, in terms of not being passive, right? If you're thinking of doing this and you think it's like it's a walk in the park, it's easy, don't do it. You're kidding yourself. You're deluded. I worked for an investment bank for over 20 years. I've been trading markets for close to 40 years, like about 30, bit over 35 years. It's not something that lends itself to just watching some YouTube videos, going to someone's course, buying their system, thinking that within an hour and a day you can be playing tennis in the Bahamas, making a gazillion dollars. All those are lies. It's a delusion to sucker you in. If you're thinking about doing what I'm doing, my one piece of advice, do not do it under any circumstances. If you are still determined after that, go and find yourself a reputable licensed broker. Okay? A reputable licensed broker. Not an online one, but an actual individual who works at an established bank or securities firm that is licensed, that has been in business for a while, that has got a good wide client base, and sit down and have lunch with them and let them get to know you and vice versa, and then take it from there. Speak to someone who is qualified, who is in the industry, who is licensed. Do not try and do it just through some stupid dumbass YouTuber or any online platform. Look, that's my 2 cents worth. This is really for my own sake, for posterity. Frankly, I've enjoyed it, and I hope I'll be back this time next year with a similar story. Thanks very much. Bye-bye.